This show is sponsored by Lightyear, a new straightforward platform offering a stocks and shares ISA with no account, subscription or custody fees. Lightyear's stocks and shares ISA will be 10 times cheaper than the average market provider over 10 years based on research conducted by Capital Economics. And its cash ISA offers easy access to the Bank of England base rate. Both accounts are flexible so you can withdraw and reinvest without affecting your annual limit. Capital is at risk and ISA rules apply. Other fees like foreign exchange fees may apply. Lightyear UK Limited is authorised and regulated by the Financial Conduct Authority.
Hello and welcome to episode 493 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leaks. Damien, welcome back. How are you doing?
I'm good, and it was our 15th anniversary this week, so I mentioned it on last week's show. So we are 15, so thank you to all those people who engaged with the post on Instagram and our other social channels. So let's hope we can keep going for another 15 years. But before we get on to what's going to be on the show, I just wanted to quickly mention the base rate cut that happened on Thursday. So it's the first base rate cut since November. So it's the third one that we've had since rates were hiked up to their high of 5.25% by the Bank of England. So we're now at 4.5%. So do keep an eye out on our YouTube channel and our social channels, because I'll be putting out a video of me discussing the outlook for interest rates going into the future. But generally speaking, with rates coming down again, you're going to hopefully see a movement of sorts on mortgage rates. They don't tend to fall as quickly because the market had predicted this rate cut. Actually, they put it as a 90% certainty before it was announced. So it is baked into what we're seeing in terms of the outlook for interest rates. It matters what the Bank of England says after that rate cut, because we're actually recording this podcast about 10 minutes after the announcement. So I don't know what the Bank of England governor is going to say. So I'll factor all that into next week's outlook. Of course, savings rates, they are heading downwards, and that's going to continue. So anyway, Andy, what's on this week's show? We're going to do 3 pieces. I'm going to do a meaty piece actually on investing, and in particular, the best investing and trading apps out there. So this is something people have asked for, but I'm not going to just list companies and costs and all that kind of thing, because it'll be boring. I'm going to go through a checklist of some of the things you should be looking at, and I'm also going to give you some scenarios. So hopefully people will recognize themselves in a given scenario or type of investor, and it'll give them some idea of the kind of platforms they may want to look at when they want to start investing. And then, Andy, you're going to be doing 2 pieces, actually. I'm going to take a back seat after that, and you're going to be doing 2 pieces of the podcast this week.
Yes, your piece, Damien, is quite a punchy piece this week, so I'll cover the final 2 pieces. They're relatively short. The first piece is about the current account switching service. They've released some latest data. I'm going to look through that data and explain which banks and building societies people are switching from and to, and the reasons why they are. And one of those reasons is because of the nice incentives that some banks are offering for switching. And for the final piece, it's just a warning really. There's a type of payment that a lot of online retailers have started to offer people when purchasing stuff online. Now, there's nothing wrong with it in terms of security per se, but there are some caveats to it, and I'll explain exactly what those are at the end of the show.
Yeah, and in particular, if you're thinking about booking a holiday, this could impact you, and it's going to have something to do with consumer protection. It's been one of the main drawbacks.
And so let's get on with that first piece of the podcast then, Damien. Lots of people have got in touch with us asking for the lowdown on what are the best investing apps, and this piece is all about that.
Having compared all of the investing and trading platforms and apps out there, I'm going to tell you which could be the best one for you. Now, I'm not going to bore you to death with a list of features and costs, and we provide all of that information on the Money to the Masses website. In fact, you can find links to all of those reviews in the description of this show. Also, most apps out there have offers when you sign up and use them, and they include some very generous cashback offers. And we are continually updating a list of all of the best offers out there. So we put a link to that in the notes as well. So make sure you check that out before you sign up to any of the platforms that I mentioned. So instead of listing all of the features and costs, what I'm going to do is give you a range of scenarios and investor types, which hopefully cover most people, and then the apps I think you should consider for each of those scenarios and why. But before I do that, I want to give you a quick checklist of the things you should be thinking about when you pick an investment app or trading platform. Now, you hear me saying investing or trading app, and technically they can be one and the same thing. Really, they are just investing platforms, and those investment platforms suit different people. Some people are just basic investors. They want to maybe have a portfolio of funds that is picked by a professional manager, so it's more simple investing. And there are people who want to regularly buy and sell shares, so they trade. So that's probably the difference between an investing app and a trading app. But really, there isn't much. They're all platforms. So I'm going to cover all of that on this particular show. So a warning before I carry on, I have to give you a warning that all investing carries risk and the value of your investments can go down as well as up. Now, with all of that out of the way, there are a whole bunch of things you should think about when you're picking an investment platform. So when we're thinking about fees and charges, make sure you check any platform fees that are out there. So check for annual or monthly account management fees. See how they're paid. So some will take it directly from investments, some from cash, some give you options, some will take it via direct debit from your bank account. Now, some platforms like InvestEngine don't actually charge a platform fee at all. Others charge a percentage-based charge, which is based on the value of your portfolio, and they tend to be better for people with small amounts invested. Some have a minimum monthly fee, and some charge a flat fee each month, which tend to be better for people with very large portfolios. Next, you want to look at trading fees. So look for commission-free trading, if possible, if you're looking at buying and selling shares. Also look at things like currency conversion, or some platforms will actually charge you for depositing or withdrawing funds. Some platforms will charge you for switching between things as simple as unit trusts and ETFs. Some won't, so make sure you know what they are. And the charges vary quite a bit, and they will have a big impact on your portfolio value going into the future. The next thing, fund fees, if you're investing in funds. Now, they will be generally the same, whatever platform you choose. But if you're looking at a managed portfolio, for example, then they will be charged very differently between the different providers. So make sure you understand what the total fee is for picking one of those managed portfolios. Also, do check for inactivity fees. Some platforms, if you're trading, do charge a fee if you don't trade for a certain period of time. Next, moving on to investment options. Think about the type of things you want to invest in. Do you want to invest in stocks and shares, ETFs, bonds, or do you want more complex things like CFDs? You need to check the platform offers the type of investment that you want to buy. If you are thinking about investing in shares, maybe you want to buy into some of the large US tech companies whose share price is very large, but you've only got a small amount of money to invest. Make sure that the platform offers fractional shares. Not all platforms do offer fractional shares. Now, account types are also important. So if you want to invest via stocks and shares ISA, maybe a lifetime ISA, a pension, or even a general investment account, it could be a junior ISA even, then make sure the platform or app offer that particular structure. Many of them don't offer all of them. Now, the other thing you might want to look at is things like ease of use. How user-friendly is the platform and the app? Is the navigation clean? Is it easy for you to find what you want? Can you trade within it, for example? Are there educational resources and tools that you can use within the app to help you when you're investing? What about customer support? Can you get in touch with them easily? Is there a live chat facility? Is there a phone number, for example? But also do look at reviews. Now, I've mentioned that we review all of the products in this particular show, but also do look at customer reviews on Trustpilot to see what other people think about the service. So the other thing you might want to look at that is specific to your needs is the minimum investment amount. So if you only invest in small amounts, some platforms might, for example, require you to have at least £500 before you can invest, while others allow you to invest from as little as £1. So that will influence your choices. Also, if you want interest on any cash you don't have invested on the platform, then you might want to look at that. We actually give a roundup of all of the interest rates, which we show on screen here, but also you can find links to in the notes of this show. Some of them don't pay anything. Some pay quite generous amounts on uninvested cash. And also do think about things like automated savings, like Roundup. Some people like that feature. They may be wanting the spare change from their shopping, for example, to be put into investments automatically. Some platforms allow that. Also, ethical investing is important to some people. Some platforms don't have a particularly wide range of investments that cater for people who want to invest ethically. Maybe they are concerned about the environment. Other platforms have a whole range of investments. Interactive Investor is a very good example of this. Other platforms might offer you things like social trading if you're into that. So you might want to start buying and selling shares. some platforms offer the ability to copy others in social trading. eToro is a very good example of that. Now, before I go on to all the different scenarios, just to point out, we have analysed the different costs and produced heat maps so you can look at the different platforms we mention and the size of your portfolio and see which could be cheapest for you. We'll put links to those in the show notes so you can look at the particular cost for you. But moving on to the scenarios, the first one I'm going to pick on is the hands-off investor. He just wants a managed portfolio. So this could be somebody who just wants to have a portfolio that's diversified, aligned with their risk tolerance, and they don't want to pick investments themselves, but they might want to have access to additional services, maybe some advice if they want, or some projections of costs and returns, whatever it might be. Then one you might want to look at is Money Farm. So that actually offers a wide range of portfolios. They include ethical investment options actually as well, but they also offer a human investment consultant. They do have a minimum investment amount of £500, so it might not suit everybody. Another platform you might want to look at is Nutmeg. Now, they have been around probably one of the longest of all the so-called robo-advisors, so they do have a track record in managing money that you can look at. They offer a wider range, in fact, of managed portfolios, including some cheap fixed allocation models, which actually don't change their allocation, which is why they are cheaper. But they do have managed portfolios. They have thematic portfolios, which means they have exposure to certain themes. Maybe it's something to do with technology that you really want to invest in. They offer something that might suit you. Smart alpha portfolios, and they have those socially responsible, ethical portfolios. They do have financial advice packages, but like Money Farm, they do have that minimum investment of £500 up front. They do reduce that for junior ISAs and lifetime ISAs. Now, one big thing people will be thinking, yeah, their managed portfolio, what's the performance like? So yes, past performance isn't an indicator of future returns, but we have analysed the performance of a wide range of managed portfolios out there, so you can look at them and see how they have done in recent history. But if you've got a large sum, so maybe you want to invest £20,000 in an ISA, do have a look at Interactive Investor as well, because they have their own managed portfolios, and because they have a fixed fee structure, so they charge a fixed fee each month, not a percentage of your money, they become better value for money the more money you have invested with them. So they are very cost effective for large portfolios. But if you want a managed service, do have a look at them if you're investing somewhere near £20,000, for example, or you might have existing portfolios that are even larger. Two others I'm going to quickly mention: Wealthify, you'll see them in some of the heat maps that we've produced, and Vanguard. I know Vanguard's a bit of a darling. They have a relatively new managed ISA proposition, but there isn't the track record which you can look at. So if that's important to you in terms of track record, then you might want to look at some of the others I've already mentioned. Scenario 2, the cost-conscious passive investor. You might be looking to build your own portfolio, principally using index tracker funds. Now, one of the apps or platforms you might want to look at is Vanguard Investor. Now, this is very low cost. It has an annual account fee of just 0.15%, which is capped at £375 a year. But there is now, unfortunately, a monthly minimum fee of £4 on the self-managed ISA and pension and the general investment account. Now, that was introduced from the end of February, and that was met with a lot of criticism, but it does have a wide range of ETFs, for example, that you can build a portfolio from. And they also have their life strategy fund range, which they're not ready-made portfolios, but they are funds that are very well diversified globally in equities and bonds, and they're very popular with the FIRE movement if you spend any time online looking at forums. Now, one of the cons of obviously investing with Vanguard Investor is that you can only have Vanguard funds, and I've obviously mentioned that minimum monthly fee, which makes investing with them expensive if you have a small amount of money. They also have a minimum investment amount of £500 lump sum or £100 a month. And if you're somebody that wants a bit of strategic overlay, you want things managed for you, then Vanguard doesn't really offer that, because they're mainly aimed at passive investors, and that keeps their cost very low. And their app is pretty limited. Now, alternatives, even if you like the Vanguard Life Strategy Fund range and you want to invest smaller amounts of money, then have a look at AJ Bell Doddle. So they have a low annual fee of just 0.15%. They don't have the cap like Vanguard Investor, but it's a very easy to use app. It's actually designed as an app first, so it's great for people who want to use it on their phone. They pay a decent rate of interest on uninvested cash. Now, they do also have a minimum monthly fee, but it's only £1. And the only thing I have to say, that is product specific as well. So you have multiple products, you can pay that more than once, but they are a great option because they do offer some of those life strategy funds, but other fund choices. But you can also invest in some limited range of ETFs, but also a limited range of shares too. So this is a bit of a jack of all trades in terms of investment platforms. And the last platform in this scenario I'm going to pick is Invest Engine. And that's for people who really want to build their own portfolio of ETF trackers. And this is a good choice because it has no platform fee at all on the DIY part of its service. It has a wide range of ETFs and it's a pretty simple and clean interface. It doesn't offer a lifetime ISA, so that is a drawback. So it's not suitable for everyone, and it might not be suitable for active traders, people who want to buy and sell shares, of course, because it doesn't offer them. They do have their own equivalent of the Vanguard Life Strategy Funds if you are a Vanguard fan, and they're called the Life Plans. Scenario 3 is the socially conscious investor. So you might want to invest in companies and funds that align with your values. So one app you could choose is Money Farm. They have a range of socially responsible portfolios. There is that minimum investment amount of £500. Another good option could be Wealthify. Now, they have ethical investment options, but they have a low minimum investment amount of just £1. If you want to run your own money and you have a sizable portfolio, you might want to look at Interactive Investor. So they have a wide range of options if you're an ethical investor, including that ACE list that looks at all the different funds that they consider to be ethically suitable. Now, moving on to scenario 4, the active stock trader. So you're somebody who is actively buying and selling individual stocks, maybe in the UK and internationally, and you want to access a large range of these at low fees and even fractional shares. Now, one choice could be free trade. So they do commission-free trading, they offer fractional shares, and they have a stocks and shares ISA. Now, one of the drawbacks is that ISA has a fee attached to it, unlike one of the other options I'm going to come on to. And there isn't lots of research on free trade that you can use. One good thing is they don't have CFDs. So if you're somebody who doesn't want to get drawn into that world, then they don't offer it on their platform. Trading 212 is another option. So they have a very large selection of stocks and ETFs, and they offer fractional shares. They have lots of guides and tutorials on their platform. And there is no platform fee for using its ISA, unlike free trade. Now, there is no pension on Trading 212. Free trade has a pension. Trading 212 does not. So that might influence your decision. Trading 212 does offer CFDs. Now, Lightyear is another one that people might want to have a look at. You can get access to over 4,000 shares across the US, the UK, and the EU. There is free ETF trading. There is fractional shares. There's multi-currency accounts. There's low FX trading fees. That's something you need to look at if you are trading in overseas shares. And they also pay a generous amount on cash that's not invested. Again, one of the drawbacks, it doesn't have a pension. It doesn't have a junior ISA or lifetime ISA at present. And that leads me on nicely to scenario 5. You might be somebody who wants to be investing in a lifetime ISA. So you need to look at platforms that offer such a product. Now, one of the first ones you might look at is Hargreaves Lansdown. Now, it's not necessarily the cheapest out there, but it does have a good service, a robust app, and good customer support. Now, the drawback of it can be more expensive than others out there. But if you want to look at another option that can be very cost effective and a very good app to boot, then ajbill.org is a good option. So that offers a lifetime ISA. It's low cost. It's easy to use. The drawbacks are there is a limited investment choice, as I mentioned earlier, with a limited choice of funds and shares. Now that takes me on to scenario 6. So maybe you're somebody who is saving money and you want to get interest, but you're also wanting to start to invest and you want to automate that. Now, one of the ones you might want to look at is Moneybox. Now, Moneybox is an app where you can even use roundups in the shop. So you buy something in the shop, for example, and the spare change can be put into a cash ISA, for example, or even into a stocks and shares ISA. So you can start investing that small change. Now, those roundup features aren't available on all platforms. It's only a limited number that do. One drawback of Moneybox, I will say, it does have a monthly fee of £1, which can be expensive if you're only putting small amounts of money into it. It's a limited choice of investments, but I do think its cash ISA range is very good because that £1 a month fee is not charged if you use it just to save money on cash. And it does tend to have a very good cash rate on its ISA and lifetime ISA. Another option is Plum. So that's an AI-driven automatic savings app effectively. So you get a pretty good rate on savings, but there are options to invest as well. Now, the way that particular app works, that the free version of it, you have a very limited experience and you have to pay a subscription to get access to more options. So that's something you're going to have to bear in mind and whether it fits your budget. One con to it is that the primary pocket is not FSCS protected, and investing charges again can be expensive if you're only investing small amounts. And the final scenario is only in here for completeness. It is in no way trying to encourage people to engage with contracts for difference, so CFDs, because most people will lose money if they engage with it. So if you are really wanting to invest in CFDs, they're very high risk, you're an experienced trader and you want a platform that can enable it, then a couple you might want to look at are Trading 212, which we've already mentioned. IG is another option. It's got a wide range of markets, extended trading hours, for example, but it doesn't pay any interest on uninvested cash, and you need to make several trades to actually benefit from the lower fees. And the other one is Plus 500. Again, wide range of CFD markets. But just to reiterate, CFDs are only for people who know what they're doing, very experienced investors. And as you will see, the FCA warnings that somewhere between 70 and maybe even more than 80% of retail investors that engage with CFDs and spread betting lose money. So there you go, Andy. There's a roundup of the best investing and trading apps. A huge amount of research went into that. It wasn't just me, it was the whole team at Money to the Masses, and especially you, Andy, actually. So if I give you a round of applause, then I think it's well deserved.
Yeah, well, thanks so much for your kind words, Damien, but you had to deliver that piece. Anyway, so let's move on to the final two pieces of the podcast then. And these are fairly quick pieces. The first piece I wanted to cover was the recent data provided by the current account switching service. And it highlights how many people have used the service, the switching service, and exactly which banks and building societies people are switching from and to. Now, just a quick reminder on what the current account switching service is. It's a free service that lets you switch your current account from one participating bank or building society to another. And it's designed to be simple and reliable and hassle-free, and crucially, they do all of the hard work for you. And so essentially what they do is they'll ensure that all of your payments in and out are automatically transferred over to the new bank account. Any remaining credit balances in your old account will be transferred to the new account. And if any payments are made accidentally to your old account after your switch date, they'll be automatically redirected and forwarded to your new account. So all of that stuff is covered. And the switch process is managed entirely by your new bank or building society and will be backed by that current account switch guarantee. Now, in the last 12 months, in the latest figures that we've received, the current account switching service has facilitated a total of 1.2 million switches, and 309,000 of those came in the last quarter leading up to Christmas. Now, in the figures that we've got, they are slightly delayed. They're delayed by 3 months. So this is actually looking specifically at the period July to September. Nationwide had the highest amount of net switch gains, followed by Barclays, TSB and Lloyds. And for those people that are watching on YouTube, those figures are now showing on screen. And you'll see from the numbers there that in terms of the net switch losses, Santander have had the most, and then that's followed by NatWest and Halifax. When looking into the details of why people are switching, 46% of people, so almost half of those, just preferred the new online banking process of their new bank. So then looking at the next reasons people were given for switching, it was 32% of those were looking for better interest on their current accounts. Interestingly, 27% of the people that switched gave the reason of spending benefits. Now, when you look at that, what that actually means is incentives such as cashback. And that makes sense because one of our most popular articles on the Money to the Masses website is our best current account switching deals article. And interestingly, those numbers of those banks that we looked at, the net gains, a lot of those have had switching deals in the last 12 months.
So I don't think, Andy, to be honest with you, that they're being that honest in when they're answering those questions. I think a lot more people probably were switching to utilise the offers and go round and round in a somewhat merry-go-round.
Damien, I think you're absolutely right, because interestingly, while we've been recording, the Co-op has released a switching deal in the last 10 minutes, and one of the team has already updated the article on the Money to the Masses website. So those watching on YouTube will be able to see that now. I'm scrolling through our article, the best bank account switching offers, cashback and incentives. And if we scroll down, I'll just quickly show on screen now, the Co-op has a deal where you can get up to £150 cash back. First Direct have got a deal where you can get £175 cash back. Nationwide, a similar deal, £175. And the TSB also has £100 cash back. I'm not going to dwell on them because they do change quite regularly, but do make sure that you go on the link on the Managed Assets website. We've already proved that we update it very regularly, so we'll put a link to that in the show notes.
And this has been a brilliant illustration of how when we do these podcasts, Andy, we're still in contact with the real world at the same time, because I've talked about the Bank of England base rate decision that's just dropped, and you've talked about a new switching incentive that's just dropped. So yeah, we're always flexing and changing what we're doing on the fly.
Yeah, that's right. We can juggle many things at the same time. Damien, I'm just going to move on to the final piece of the podcast. It's a very short piece, actually. It was highlighted recently in the press about a type of payment that online retailers are offering people. And the reason they're giving is it cuts down on friction, it makes payments easier. But the problem is there is a bit of a catch. So there are a number of retailers now that are offering a new way of paying, and it's a paying by your bank app. Essentially what you do is you click the button and then it seamlessly transfers you via your banking app and will log you in securely through biometrics, either fingerprint, maybe a passcode, or even your face recognition. And then through that step, you can then authorize the payment and push it over to that retailer. It is ultimately like doing a bank transfer. Super quick, super easy. But there is a catch. Because you're effectively transferring money directly to that retailer, you're not using any kind of card. You're not using a debit card. You're not using your credit card. And the problem with that is there is ultimately no consumer protection, because we mentioned on the podcast before, if you pay for purchases via credit card, you get something called Section 75 consumer protection. If you pay by debit card, you are also covered in a similar way. It's called the chargeback scheme. And a couple of examples of companies that are using this at the moment are Just Eat and Ryanair. And in the case of Ryanair, obviously, you'll be spending a fair amount of money on those, so you do need to be careful.
So that's an important point with the consumer protection, particularly on the credit card. So with Section 75, don't forget that if you buy something that costs between £100 and £30,000 and you pay an amount on your credit card, it could be any amount, it could be as little as £1. It's just the cost that's got to be between the two amounts that I've mentioned already. Then you will be protected because the credit card company is also liable. So let's say, for example, you bought a holiday and it didn't happen because the company went bust and you paid for it on your credit card. You could actually make a claim against the credit card company as well for reimbursement. So it's an important consumer protection. But if you're just transferring money, you don't get that. Instead, what a better thing to do would be to still pay for your holiday or part of it, in the case where we're talking about Ryanair, on your credit card, and then immediately go onto your credit card company's website or app and pay off the amount using the money you've got in your bank account, rather than paying by that process you've mentioned, Andy, which is using the biometrics in the app, effectively doing a bank transfer to the retailer directly.
Yeah, and if you haven't got a credit card and you want to pay by debit card, there is the chargeback scheme, which works in a very similar way. The numbers are different. There isn't a £100 minimum or a £30,000 maximum, and it's offered by your bank in partnership with the debit card provider, so Visa or MasterCard. It's not a legal right. It's a way of you being able to dispute the payment, and it does offer you some protection, certainly more protection than doing a direct transfer in the case of these online retailers that are offering that now.
So we'll put links to an article on the Managed Assets website which explains the consumer protections under Section 75 and the chargeback that we've mentioned. But it's also worth pointing out there's nothing wrong with the method of payment. It is very secure, so you click on the website, it might open your app on your phone and use those biometrics. It's just so you are aware that there is less consumer protection, so you can make an informed decision. So that's it for this week, Andy. We are done. As usual, please do review the podcast on the app of choice. Give us 5-star reviews where possible. Do also engage with us on our YouTube channel, our social media channels like Instagram, TikTok. Do join our Facebook group, facebook.com/groups/money to the masses.
And so, yeah, that's it. We're done for this week, Damien. So all that's left to say is until next time.
Until next time.